price of oil has collapsed during this period of tariff worry and uncertainty. For an expert view on the price, we're joined by Rebecca Babin, senior energy trader at CIBC Private Wealth. Rebecca, thanks for joining us. The concern of the market is clearly a global slowdown that will undercut demand for crude oil. How justified are those worries?
So I think that the concerns are justified. And the reason we're seeing crude kind of give back more of its gains than the equity market is the tariffs are still very targeted at China. And China is the world's largest importer of crude and still the key driver of demand growth. Now, there is a shift towards India, but China still really matters for demand growth in crude. So we started the year looking for 1 million barrels of demand growth in 2025. With the way things stand right now, and that's a big assumption that they don't change, you're seeing those estimates be cut back by about 300,000 to 500,000 barrels. So looking at demand growth of 500 to 600,000 barrels of demand growth. That's a significant adjustment, but it comes at the same time that we're seeing non-OPEC supply growth grow at 1 million barrels and OPEC deciding to unwind their production cuts a little bit more aggressively. So it's not just this one thing, it's that demand is in jeopardy and supply is also increasing and hasn't backed off. I will say this, I do think U.S. shale, which is the balancing barrel for the crude market, is likely to start to slow down its production growth. We're expecting 300,000 to 400,000 barrels of supply growth out of U.S. shale. That's a high estimate. That could start to come down, and we're going to listen for earnings guidance here in the coming weeks to see how they're reacting to this and what they're going to do with supply growth.
Crude oil soared in price yesterday as the markets jumped on the 90-day tariff pause news. What's that telling us about the mood of the market, that crude would soar just like the equity markets did on that fragment of news?
That's a great question. I think what it tells you and what it kind of highlights is crude is both a physical market and a financial market. You have both players in one market, right? And so when financial markets see this kind of reduced risk or the worst case scenarios avoided, you see the financial players really start to chase crude. That doesn't necessarily mean the physical players or the fundamentals have shifted meaningfully. It just shows you that the financial and the macro kind of players can really influence price. So to me, that was just a short covering kind of episode that stemmed from the equity rally and was financial players kind of covering shorts. I don't think when I look at what's come out overnight and when I look at the balances and the effective tariff of 23%, that the physical market has changed. I think that's why we're giving a lot of it back. That doesn't mean, though, that we can't see these massive, vicious short covering rallies if we have events like that. And what will change the physical market is if we see a negotiation with tariffs with China that significantly changes how people are predicting demand. But I do think it's a trader's market, and you have to be very aware of the macro environment as the key driver for crude and not necessarily that physical market. So it's a delicate balance, and it's very tricky.
One thing you track closely is sentiment in the oil market, and you currently characterize sentiment as extremely bearish. Is that a silver lining? Is that a reason perhaps to believe that we could be close to a bottom?
100%. So sentiment is horrific. Every note I read is worse than the last. And that doesn't mean they're wrong. I just think it means we're getting closer to pricing in that kind of worst case scenario. I do think when we look at 50, I think we'll have enough supply coming off in the US to buffer kind of a very extreme demand slowdown. Where we are here, I think we are approaching kind of 55. If things don't get worse, that could be a support level. So I think you can trade this range, this 55 in WTI, let's call it 58 in Brent, but I wouldn't get overly greedy on these rallies. I think you have to be very disciplined because keep in mind, the upside really is capped now. OPEC has changed their posture. They are no longer this balancing support in the market. They're bringing barrels back. We have a lot of spare capacity. So if you get these geopolitical risk rallies or these rallies from macro, I think, these 5-10% rallies, you have to be very disciplined and take your trades there.
Okay, we're almost out of time, but what about Russia and Iran and the possibility of sanctions, further sanctions there that further constrain the ability of those two producers to supply the market?
So we have a big meeting this Saturday with Iran. There's supposed to be some indirect or direct negotiations, depending on who you ask. I think before we declare victory there, that is going to be a long process. Now, a long process means that it might delay us enforcing these stricter sanctions. But if progress isn't made, I actually do think we could see maximum pressure applied in the coming months and that shift the supply and demand balance. I think it's easy to claim that we're negotiating up front and the market says, oh God, I was predicting those barrels to be off the market. Let me change my estimate. These gains are going to be hard fought. I would actually think that we do see some Iranian barrels off the market in the second half of the year if we don't see positive discussions. Russia, Ukraine also, it's dragging out. I'm very hesitant, though, to think that Trump will enforce the sanctions on Russia. I think he's going to give that a long time to play out, a longer lead time than he gives Iran. So I don't see that as a major supply risk. I'm much more thinking that the Iranian barrels are a supply risk.
Rebecca, thank you so much, as always, for your substantial insight into a key market for Canadian investors, the crude oil market. Rebecca Babin, senior energy trader at CIBC Private Wealth.